Hello guys, this is Amol Khedkar. Today I'll be discussing about the topic that you see on your screen, which says how Buffett won his $1 million bet. Before I get started, please don't forget to subscribe to my channel and also do share this video so that people can become financially educated as much as possible. All right, let's get started. So, this is a pretty old article, but I really wanted to share this because I've been investing in the stock market for almost a couple of years now, and based on my experience, I have not always followed Warren Buffett, okay, who is the Oracle of Omaha. But in this case, I really agree with him. Okay, I just wanted to get it out there before I jump into this. Uh, so, Warren Buffett had placed a bet, okay, and to the hedge fund managers, a 10-year bet saying that index funds are not going to beat hedge funds in the 10-year timeline, okay. So I'll just go through a few pieces in this article and explain to you what happened. So when investing, sometimes the best way to make money in the stock market over time is to do nothing, just invest passively. My experience is that this really works, okay. I think mutual funds and mutual fund industry is very overrated, okay. This is my personal opinion, and I think with all the expense ratios and other fees that are involved in mutual funds, index funds really outperform mutual funds in the long run. That is my opinion. That's what Warren Buffett did in making a $1 million bet that he could do better than a portfolio of hedge funds. Did the Oracle of Omaha find some great bargain price stocks? Did he make the deal of the century by finding an emerging tech company? Nope. He simply said that by investing in a boring low cost stock index fund, you could outperform most hedge funds over the past decade. He made no new investments and didn't time the 2008 market crash. He just stayed put on an index fund. This is really interesting because I think the entire mutual fund market is based on the portfolio managers and active fund managers and the mutual fund agents making money out of it, okay. I think it's everybody has their hands dirty into it, and that's why nobody wants to talk about it, okay. That's just my honest opinion. You come here for the truth, so I'm just trying to give you the truth. How clever is that? Well, it requires no investing skill, although when you do the math, it's brilliant. Just imagine this, okay? This is just a low cost index fund that has very low expense ratio. If you don't know what an expense ratio is the money that the fund house charges for them to manage your fund, okay. So if you're investing, say 10 lakh rupees, or say $10,000 in one of the mutual funds, okay. And if it's a equity mutual fund or debt mutual fund, there are two types in it. If it's an equity mutual fund, then surely some of the small cap or mid cap mutual funds have pretty high expense ratios of around 2%, okay. 2% is a very high expense ratio, okay. So what that means is that the fund manager and the mutual fund agent are getting 2% out of your assets under management, okay, which is the AUM, okay. So it's not like the profit, it's not the 2% on the profit that you earn on the fund, it's the 2% on the assets that you have under management, and they are paid on a daily or a monthly basis, okay. So that's why from a mutual fund agent's point of view, they need as many assets under management as possible for them to just get the commission out of it, okay. So recently I was just trying to get money out of one of my mutual fund agents, and they were so keen on just keeping that money under their radar, okay, because as I said, they get the profit out of it, as much as assets that they have under management, they just get the profit out of it. That's why they were so keen on keeping it under their management. But I was very adamant, and I just said that I really need to get out of this no matter what, okay. So that guy was selling me literally I had it in debt funds, and even the debt funds started going negative. And that guy was selling me overnight funds and low cost debt funds and everything like that, because he just wanted to keep the assets under management, okay, as much as possible. That was his own agenda, okay. So I just want to let you know that mutual fund agents definitely have their own agenda in trying to keep as much assets under management as possible. So, but Warren Buffett has proved that within 10-year timeline, index funds outperform hedge funds. I will go through a few more paragraphs into this. Here's some evidence from S&P Indexes, okay, which tracks the performance of index funds versus actively managed funds over time for every type of fund. Big company stock funds underperformed indexes nearly 93% of the time for a 15-year period. Just imagine this, okay? What about bond funds? The record for active managers is even worse. Some 98% of government bond funds lagged the index over a decade and a half. So whether it's a bond fund like a debt fund or an equity fund, they all cannot beat index funds, okay. What an index funds means is that, if you don't know, you just bet on the index, okay. And the economy is just going to rise because the stock market has an year on year growth of at least 15%, in the normal times, okay, not in current times, because right now the stock market has gone way down, because every other company goes down. And just look at the situation right now, okay. The stock market is almost 25 to 26% down right now. And what about the mutual funds? If you look at any of your mutual fund investments, all of them are also coming down. So what do the active fund managers do, okay? If you are paying them 2% expense ratio for them to manage your fund, what exactly are they doing? To be honest, nothing, okay. If a person like me can understand what are the undervalued stocks and pick them and gain money out of them, I don't think fund managers can do anything different, okay. They cannot find these kind of hidden gems, that are the like these are the so-called hidden gems that all these fund managers are looking for. They cannot find that, okay. It's not like a magic wand that they wave, and just companies are just attracted towards them as if there's no tomorrow. It just doesn't happen, okay. So I think index funds definitely outperform mutual funds in the long run. Again, I'm saying this, I don't agree with many things of Warren Buffett, okay, but this is something I surely agree with from him. And I have experienced this personally, so I can definitely vouch for this. The reason active managers rarely beat low cost baskets of securities is that they have to charge more for management while delivering lower returns. Just imagine this, okay? So, the expense ratio cuts out of your returns. It also cuts out of your assets under management, and it also cuts out of your returns. So, you get lower returns, okay? So, they do not generate any kind of alpha. These are all the gimmicks that all the fund managers keep on telling you, and all the mutual fund agents keep on telling you that they generate alpha, they generate more than 15% returns. It's nothing like that, okay. Index funds can give you 15% year on year returns, and Warren Buffett has proved it, okay, within a 10-year timeline. So what this guy did is that that story comes later, but I'll just give you the story before. So what Warren Buffett did is that from 2007 to 2017, Warren Buffett placed out a bet saying that any hedge fund manager can come to me, and I will place a $1 million bet saying that index funds will outperform hedge funds or active mutual funds in the long run, within a 10-year timeline, okay. And he won that bet, okay. So in 2017 he won that bet. As you can see here, the winning margin for Buffett wasn't even close. When 2017 ended, Buffett's plain vanilla stock fund averaged 7.1 compounded average return versus 2.2 for the hedge fund basket. While the numbers don't sound all that impressive, the compounding is powerful. In stock market, compounding is a very important thing, okay. Let's say you started out with $100,000 and invested for 30 years. Assuming you didn't invest another dime, you would have more than 761,000 after 3 decades in the index fund. Using Buffett's example, you would only accumulate 192 thousand at 2% return according to AARP calculator. So just look at the difference, okay? 192,000 and 761,000. It's almost like, almost a 5 to 600,000 difference. So the compounding is a very, very important thing. So the bottom line is that by investing passively in a dirt cheap index fund, you could nearly quadruple your next nest egg. Just imagine this, okay? I think the entire mutual fund industry is based on just a hype, okay? They market their tools very, very properly on the television screens, on the hoardings, on the, on everything, like they have very good marketing tactics, because everybody is getting their fair share, okay? Everybody is getting their share out of this, So the mutual fund advisor, the double quotes advisor, because to be honest, there's nothing to advise on the mutual fund, okay? Because you don't have any visibility on what the fund manager does, okay? So the fund manager is the one that in double quotes again manages the fund on your behalf, okay? And that guy literally gets a 2% stake by doing absolutely nothing, okay? So if the fund manager is really good, why aren't they able to generate alpha in such a market, okay? So right now the market is almost 25 to 26% down. If a fund manager is able to generate alpha in this kind of market, then I will gladly pay 2% expense ratio for an equity mutual fund to that fund manager for any fund house, okay? So I will not name any fund house, but any fund house that comes to me and tells me that they will be able to generate 15% more returns on an equity mutual fund, okay? I will gladly pay it to them, and I need that in writing. The fun part in this is that no mutual fund manager or the mutual fund the agent will give you assured returns, okay? At least in the bank, when you put money into a bank, you know the savings rate, right? You know the fixed deposit rate, right? So it's not that high, I agree, okay? I'm not disagreeing on that. It's not that high, but at least you have the assurance of it. Mutual fund investors are never going to give you any assurance. So if that's the case, then I think index funds are the best way to go, okay? I don't think that mutual funds are really can outperform index funds in the long run, and Warren Buffett has proved this, okay? Warren Buffett is the most well-known investor of this century, okay? This guy has never ran a company, okay? But he has just invested in other companies and generated all the wealth out of it. So Warren Buffett does not believe in mutual funds, okay? So I personally think that mutual funds are really very, very overrated, and I don't think they give you any sort of returns in the long run. Index funds are the best way to go, and it's if you trust in the market, if you trust in the US economy, or if you trust in the Indian economy, just index in a plain vanilla mutual index fund, okay? Whether it's a Nifty index fund or a Sensex index fund, just put your money into it, and it will generate more than 15%, at least 15% return, okay? I can guarantee this to you, because what happens is that what has happened is that in the last 30 years timeline, stock market has definitely given at least 15% returns on a year on year basis, okay? Right now the stock market is almost 25 to 26% lower, but okay, this is an unusual situation. So if you look at the mutual funds as well, right, all of them are going down. So what's the point of having a mutual fund if you have a fund manager that is like so-called highly qualified, and he manages your fund on your behalf, okay? I don't buy that argument, okay? This is my honest opinion. And if you want to hear any sort of sugar coated things, you can go to other channels and look at all the goody things. But I think at least I should have the opportunity to voice my own opinions in a without any sugar coating, without any obstructions, okay? So this is my honest opinion. And I think as I said, I'll just repeat it once more. Index funds outperform active mutual funds or active hedge funds in the long run over a 10-year period. So if you don't know what a hedge fund is, hedge funds are again, hedge funds are like the mutual funds on drugs, okay? And I'll just say something like that. So if you see, with hedge funds, the management fees can be egregious, up to 2% annually plus 20% of the profits. if managers aren't beating the market in a big way, their take cuts deep into your pocket. So just imagine hedge funds really have much higher expense ratio than the active mutual funds. Okay, so and this was my take on how exactly the mutual fund industry is just trying to encash on the ignorance of many people. Okay, and I think index funds definitely outperform active mutual funds or hedge funds in the long run, and Warren Buffett has proved has proved it. So if you like this, if you like my analysis of this article, and if you agree with my opinion or if you disagree with my opinion, please let me know in the comments, and we can have fair and square discussion. I'm open to discussion. I'm not saying that I'm the god, and I have the whole truth and nothing but the truth. But this is my experience, and I think I should get the opportunity to try to display and try to just present my own experience. So please do like and comment, and also share this video if you agree with me. Okay, thank